Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's topic with you. We're starting off with a story that's been making waves in the financial sector. According to recent reports, foreign institutional investors, FIIs, have been strategically reallocating their investments, moving from large-cap stocks to mid-cap and small-cap segments. This shift has sparked interest among market analysts, who believe that smart money is targeting growth opportunities. To break it down, FIIs have been net sellers in the large-cap space, with outflows exceeding Rs. 1.16 lakh crore so far this year. However, they've been showing interest in sector-specific opportunities in small and mid-caps. Historically, mid-caps and small-caps have tended to outperform large-caps in bull markets, but it's essential to remember that corrections in these segments can be brutal. Our guest expert, Amar Dio, notes that the rotation of money into mid-cap and small-cap stocks clearly indicates that smart money is targeting growth opportunities. With GST 2.0 reforms on the horizon, low inflation, and expectations of a likely U.S. Fed rate cut later this year, the market sentiment seems optimistic about long-term growth stories. Dio also highlights a new theme that has the potential to turn into wealth creators in the next 5 to 10 years. India's economic growth is expected to pick up pace over the next 2 decades, potentially reaching 20 trillion by 2047. One area to explore is the AI, data centers, and semiconductor business, with India positioning itself as a chip hub alternative to China. These sectors could witness a CAGR of anywhere between 15%–25% over the next 5–10 years, creating a 10x to 5x market expansion opportunity. As we continue to navigate the complex world of stocks and finance, it's crucial to stay informed and adapt to changing market conditions. We'll be discussing more about this topic and other key developments in the world of finance throughout the show. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, where we dive into the world of finance and technology. Today, we're exploring the fascinating realm of artificial intelligence in banking. Our first story highlighted Citigroup's innovative AI-powered tools designed to enhance client communications. Now, let's take a closer look at how another major player, Wells Fargo, is leveraging AI to optimize its financial operations. As we've seen, Citigroup has unveiled 2 exciting solutions, Ask Wealth and Advisor Insights. These cutting-edge tools are set to revolutionize the way wealth advisory teams interact with clients, providing faster and deeper connections. But that's not all. Wells Fargo has also made headlines with its new Medium-Term Note Program, Series Y, and Subordinated Medium-Term Note Program, Series Z. This strategic move is part of Wells Fargo's efforts to optimize its financial operations, offering more flexibility in managing its debt portfolio. The medium-term notes will enable the bank to raise capital over a specified period, attracting investors seeking stable returns through fixed-income securities. It's a clever approach, and one that underscores the bank's commitment to maintaining a robust financial foundation while providing attractive investment opportunities. Now, I know what you're thinking. What does this mean for investors? While both Citigroup and Wells Fargo are certainly worth considering, it's essential to remember that AI stocks can offer greater upside potential and carry less downside risk. As we always say on the Riskwiser Zone, don't panic, take a step back, assess the situation, and make informed decisions. As we navigate this complex financial landscape, it's crucial to stay ahead of the curve. The elves, our technical analyst friends, would agree that AI is transforming the banking sector in profound ways. And as I always say, the more things change, the more they stay the same. The fundamentals of investing remain unchanged, even as technology advances at breakneck speed. So, where do you stay your money Monday? Will you be investing in Citigroup, Wells Fargo, or perhaps exploring other AI-driven opportunities? Whatever your strategy, remember to stay informed and adapt to the ever-changing market conditions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. We'll be exploring more exciting developments in the world of finance and technology. Until then, keep your wits about you, and as I always say, a correction is when you lose money, a bear market is when I lose money. Let's hope it doesn't come to that. Welcome back to the Riskwiser Zone. We've got a fascinating story to wrap up today's show, and it's all about the high stakes of office romances in the corporate world. Recently, Nestlé CEO Laurent Frege found himself out of a job due to an undisclosed romantic relationship with a subordinate. This isn't an isolated incident. We're seeing a trend where C-suite executives are facing consequences for their workplace dalliances. Now, it's essential to acknowledge that office romances can be complex and delicate matters. While some companies have policies in place to address these situations, others may not have clear guidelines or mechanisms for reporting and investigating such relationships. The key question here is, are internal corporate alarm systems working effectively to prevent or address these issues? On one hand, it's crucial for companies to maintain a professional work environment, free from favoritism, conflicts of interest, or even the perception of impropriety. When executives engage in undisclosed romantic relationships with subordinates, it can create an uneven playing field and undermine trust among employees. On the other hand, we must also consider the human aspect of these situations. People form connections and relationships in the workplace, and it's not always easy to navigate these complexities. Perhaps the solution lies in finding a balance between maintaining professional boundaries and acknowledging that humans are, well, human. The case of Laurent Frege serves as a reminder that, in today's corporate landscape, transparency and accountability are paramount. As we've seen time and again, social media and internal whistleblowers can be powerful catalysts for change, shedding light on issues that might have otherwise gone unaddressed. So, what can we take away from this story? Firstly, companies must prioritize creating a culture of openness, respect, and clear communication. This includes establishing robust policies and procedures for reporting and investigating workplace relationships. Secondly, executives must lead by example, demonstrating a commitment to upholding the highest standards of professionalism and integrity. As we close out today's Riskwiser Zone, it's essential to recognize that the world of corporate governance is complex and multifaceted. While office romances might seem like a trivial matter, they can have far-reaching consequences for individuals, companies, and the broader business ecosystem. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.